I think there is now a general agreement that climate change happens. It's taking place right now. And a big question is, what are the effects for corporations, in particular for the risk of corporations? So we have a new paper where we're trying to estimate the effects of carbon emissions on tail risk. So tail risk means that a very bad event, a jump-like event happens. So think a little bit of it as what happened to the German utility companies after the Fukushima disaster. Germany very abruptly decided to exit nuclear power. As a result of that, within a few months only, the big German utilities, E.ON and RWE, lost about 40% of its market cap. So that's a big disaster for investors in these companies. That's what we think of when we talk about jump risk. So here in this paper, we're estimating the effect of carbon emissions on jump risk. So as I said, there's a general agreement that climate change is happening. There's also an agreement that in order to achieve the targets that politicians have set in order to combat climate change, a lot needs to happen. So a lot of regulatory changes need to take place. Think of taxes on carbon emissions, think of cap and trade schemes. Now, if a company is producing lots of carbon emissions, that's potentially very risky because it may mean that the business model is not viable anymore. For investors, that's a big risk. So it can lead to a big jump in the stock price. But beyond regulatory risk, there's also a technological risk. We already see that more and more companies become fuel efficient with battery technologies. And if you think about established companies, oil companies, for example, or car manufacturers, for them, technological changes in response to climate change can also have very, very negative events. They may be wiped out of business. So we're estimating the effects of carbon emissions on tail risks. And in particular, we try to estimate whether markets believe that these regulatory risks and technological risks, sometimes labeled carbon risks, are reflected in the prices of options. So we're looking at options because options allow us to capture these tail risks, these events where all of a sudden the stock price jumps south and destroys a lot of value for shareholders. Now, what's interesting with options is that options are forward-looking. So investors trading these options, so the information you can elicit from these options tells us something about what investors expect. So it's possible to elicit from options the probability and the severity of a jump-like event as a result of carbon emissions. Now, what is interesting actually is that carbon risk itself is a very concentrated risk. So there are only 6 industries in the US that generate about 80% of total carbon emissions in the S&P 500. There are only 5 firms that produce about 25% of all carbon emissions. So it's a very concentrated risk. So it's important to understand whether these firms also have higher tail risks, or whether investors are expecting that the stock prices of these firms at some point will drop because of regulatory or technological changes. So this is exactly what we find. So when estimating the tail risk out of options, we find that there's a very strong correlation with carbon emissions. So firms that are producing a lot of emissions, they have a significantly higher tail risk. So investors are expecting something jump-like, something bad to happen for these companies. We're using data from the Carbon Disclosure Project, as it was formerly called, CDP, which is the most comprehensive data set on carbon emissions that is out there. It's very reliable data, and it's data that is covering, in our analysis, the S&P 500 firms. So clear evidence that investors expecting carbon emissions to have potentially detrimental effects on firm value because of these technological and regulatory risks. In addition, what we're exploring is whether there is some kind of term structure in these risks. So in our main test, we're focusing on options that have a maturity of 2 years. So we see that already within the next 2 years, investors are expecting some kind of jumps, disasters if you want, because of carbon risk. It's not clear that it's going to happen. It's only meaning that investors are to some extent expecting this. So 2 years is a pretty short horizon. However, if you look at other papers and other evidence, it seems that a lot of investors actually care about such short-term horizons and expect something on the regulatory or technical front to happen within that time period. Now, we also look at shorter and longer maturities of options, so slightly shorter horizons for investors and longer horizons. On the short horizon, 1 month, we see little. So it doesn't seem that investors are expecting something to happen in a very short run. But if you look at 3-year horizons of options, you also see that there's a lot of risk, tail risk, we call it carbon tail risk, reflected in the options. And it's actually increasing over time, which is natural because the longer the horizon, the more likely it is that such a jump-like event is going to happen. We also explore other variables that may reflect the risk of companies. For example, we're looking at CDS spreads that are reflecting, if you like, the general business risk of a firm. For this variable, we find very little. So it really seems that carbon risk matters for the tails. So it's not that your rating, your average risk is affected. It is that something extreme may happen with a certain probability. What, however, we do find is that there's more general disagreement among analysts about how to value a company, how to expect earnings when firms produce more carbon emissions. So we call this disagreement. Disagreement among analysts is generally larger if a firm has higher emissions. So that's intuitive, because if you have a lot of emissions and you have a lot of uncertainty about how the Paris Agreement, for example, will be implemented, what politicians are going to do to follow up on their pledges to reduce carbon emissions, then this is likely to lead to a lot of disagreement among analysts on what the earnings of the firms will look like. Now, so overall, the results of the picture, the results in the picture of the paper are very clear. Very strong evidence that carbon risk matters, that carbon tail risk is out there. Investors expecting something potentially disastrous to happen for firms that are producing large carbon emissions. So our results are very important for firms, because for firms that have a high output on carbon emissions, they need to tackle this. They need to think about how to become carbon neutral ideally, or how to reduce carbon emissions. But it's also very important for institutional investors and other investors, because they need to think about how to reduce the risk, either by means of diversification or by using hedging strategies to reduce carbon tail risks. So important implications for firms and investors that come out of our paper.